I learned a very expensive lesson early in life. A market can look healthy on the surface long after the foundation underneath it has started to rot. That is the part most people never understand until the bill arrives. They think danger announces itself with screaming headlines, with red candles, with economists on television telling them to brace for impact. But real danger rarely enters that way. Real danger enters quietly. It enters through plumbing, through rollover schedules, through interest expense, through liquidity that leaves the room before the crowd notices the air has changed. And by the time the crowd notices, the exits are already crowded. That is why I want to talk to you plainly today. I do not want to give you the comforting version. I do not want to tell you that because the index is still near its highs. Everything is fine. I do not want to tell you that because the market has survived every scare of the last 15 years. It will automatically survive this one. In the same way, I have lived too long, watched too many cycles, and made too many decisions with real money on the line to give you that kind of fairy tale. What I see right now is not a normal late cycle wobble. What I see is a liquidity trap already operating beneath the floorboards while most people are still admiring the wallpaper. If you want to understand markets, you have to stop staring at the obvious number. It is not enough to watch the S&P 500. It is not enough to watch your favorite stock. It is not enough to watch one big technology company and tell yourself that because it still looks strong, the system must still be healthy. The most important number in a market like this is not the headline price. It is the amount of liquidity the system is losing and the speed at which it is being asked to refinance old promises at new rates. That is the number that has always been the number. When I was younger, I used to think the market was mainly a voting machine. I would watch sentiment, stories, narratives, personalities, and those things do matter for a while. But the longer I stayed in the game, the more I realized the market is also a settlement machine. Promises come due, debt matures, credit must roll, interest must be paid. When the system has abundant liquidity, almost anything can be postponed. Weak businesses can survive. Overpriced assets can remain overpriced. Investors can confuse rising prices with sound structure. But when liquidity starts to leave, postponement stops being a strategy. Then the arithmetic takes control. And arithmetic has no empathy. I have seen this movie before under different costumes. I watched people call Japanese real estate a miracle. I watched them call the internet a new law of economics. I watched them say housing prices could not fall nationally. I watched them say the Federal Reserve had solved the cycle itself. Every generation gives its bubble a fresh vocabulary, but beneath the language there is usually the same old structure: easy money, expanding confidence, rising asset prices, a crowd that mistakes access to liquidity for proof of genius. Then, when the system must refinance itself under tighter terms, the spell breaks. That is why I do not begin with stories about innovation. I begin with refinancing. I begin with debt service. I begin with how much of the future has already been promised away. The United States has spent years living inside an environment that made almost every asset look smarter than it really was. Money was cheap, duration was rewarded, risk was underpriced, investors were trained, almost like livestock, to believe that every serious decline would be met with rescue. Buy the dip, trust the pivot, stay fully exposed. Wait for the central bank. Wait for the next wave of easing. That was not just a habit, it became an identity. Entire careers were built on it. Entire retirement plans were built on it. Entire valuation frameworks were built on it. Then the rates changed. The old debts did not disappear. The deficits did not disappear. The promises did not disappear. Only the price of money changed. That single change has more power than most people understand. If a nation carries modest debt, it can tolerate higher rates. If a company carries modest debt, it can refinance without changing its character. If a household has margin in its budget, it can absorb stress. But if a nation, a company, or a household has spent years designing its life around artificially cheap money, then when money becomes expensive, the structure does not merely slow down. It begins to deform. That is where we are now. People look at the federal debt and treat it like an abstract political talking point. They should look at it the way a lender does. They should look at it the way a risk manager does. They should look at it the way a bondholder does. The debt is not just large. The debt must be serviced. And when old debt rolls into new debt at higher rates, interest expense is not a side note. It becomes a force. It crowds out choices. It drains productive capacity. It forces more borrowing not to build, but simply to carry what is already there. That is not growth. That is oxygen being consumed by the engine itself. I want you to picture the system as a reservoir. When the reservoir is full, everybody thinks they are talented. The corporations can issue debt. The Treasury can issue debt. Private equity can roll debt. Speculators can finance dreams. The weak can hide beside the strong because water is everywhere. But if the reservoir stops filling and the demands on it keep rising, then the truth of each structure starts to reveal itself. The strong can still function. The weak begin to gasp. Then even the strong must become selective. That is why the surface can look calm while the deeper reality turns hostile. The average investor sees a high index and thinks abundance. The experienced investor asks a different question: at what rate is liquidity being drained, and who must refinance next? The Treasury must borrow. The Federal Reserve can reduce or expand its balance sheet. The private sector must roll maturities. Commercial real estate must roll maturities. Regional banks must carry paper losses while pretending that time is a solvent. Private credit funds promise liquidity to people who never had to test whether that liquidity was real. All of these promises rest on the same floor, the reservoir. If the floor is dropping, you do not need a crisis headline for a trap to exist. You already have the trap. That is why the years leading into a break are always so confusing to the public. They expect danger to be loud. It is often quiet. They expect weakness to begin in the obvious names. It often begins in the neglected corners. Small caps start to sag. Regional lenders start to wobble. Bid-ask spreads widen where no television anchor ever looks. Credit becomes a little harder to place. Buyers require a little more yield. Private marks stay stable only because nobody wants to admit what a real mark would show. And then because the index still looks respectable, people decide all of those things must not matter. I have made good money in life by taking that sentence more seriously than the crowd ever does. Small things matter. Hidden things matter. Funding matters. When I hear investors tell me that fundamentals do not matter anymore, I hear the oldest confession in markets. It is not really an analytical statement. It is an emotional one. It means the environment has rewarded price chasing long enough that people have forgotten that cash flow, refinancing, and valuation are not optional subjects. They are simply dormant until liquidity turns. Then they become the only subjects. What makes this period more dangerous than a normal slowdown is not merely the amount of debt. It is the combination of debt rates, inflated expectations, and moral habit. We trained an entire market to believe that policymakers would always have a clean way out: cut rates, reopen the spigot, reinflate assets, calm the system. The problem now is that the old rescue itself carries a cost it did not carry before. Inflation is not dead enough to ignore. The currency cannot be taken for granted. The long end of the bond market is not obedient enough to simply nod along with every easing gesture. The old rescue is still possible in form, but not in consequence. It no longer saves without damaging something else. That changes the whole game. When the rescue itself creates a second fire, investors can no longer rely on one simple reflex. That is the real liquidity trap. It is not just that liquidity is being drained. It is that the institutions people expect to refill, it may not be able to do so without reviving inflation, damaging the dollar, or losing what remains of their credibility. If you understand that, you understand why this cycle is not just another buy, the dip tutorial. You are no longer dealing with a market that can assume one universal backstop with no side effects. You are dealing with a market that must choose which pain to accept. And markets hate choice when every option is pain. I think it helps to break this process into stages, because most people can only recognize a crash after stage 3, while the prepared investor is doing most of the important work in stage 1 and stage 2. The first stage is the illusion. That is the period when rates are higher than people are comfortable with, but enough cash is still moving through the system that asset prices remain surprisingly resilient. The crowd grows cocky here. It says the experts were too bearish. It says the economy can handle higher rates just fine. It says the old relationships no longer apply. This is the stage that humiliates cautious people. It is also the stage that conditions reckless people to trust the wrong signal. The second stage is the squeeze. The surface numbers still look decent, but beneath them the supports are thinning. Treasury issuance absorbs cash. Balance sheet reduction removes another layer of support. Borrowers who assume they could refinance easily discover that refinancing still exists, but not on the old terms. The strong get more selective, the weak get more promotional, the zombies tell bigger stories because they cannot show stronger cash flow. The banks smile in public and grow rigid in private. More assets can still be sold, but fewer can be sold gracefully. This is where we are now. This is the stage where the public feels confused because the news does not match the sensation. They feel a pressure they cannot name. Their portfolios may still look respectable, but opportunity feels thinner. Breadth deteriorates, smaller names cannot keep up. More capital crowds into a handful of giant names because the crowd mistakes size for safety. Index concentration deepens. People think they are diversified because they own the index, but the index itself is turning into a narrower and narrower bet. That is not safety, that is hidden dependence. Then comes the third stage, the break. One piece of the system finally fails in a way that cannot be shrugged off as isolated. It may be a regional bank, it may be a private fund gating redemptions, it may be a credit event. No one expected to matter until it matters to everyone. The first break is never important because of its size. It is important because of what it reveals. It reveals that liquidity was not abundant enough to absorb stress. It reveals that marked to model was concealing marked to market. It reveals that the private valuation and the real clearing price were living in different universes. Then the crowd sees what the prepared investor already knew. The index was never the story. The plumbing was the story. Once the break is visible, the system starts to reprice speed itself. Margin calls force action, lenders tighten. Buyers step back and require a discount. The difference between a willing buyer and a desperate seller becomes the most important spread in the world. This is the stage where courage and capital become the same thing. If you preserved one, you can use the other. After that, if the authorities respond with large enough force, you get the fourth stage, the reflation. This is the stage the public usually confuses with safety. They see policy response and think the danger is over. The wiser investor sees something subtler. He sees a new cycle beginning from a lower and more honest base. If he has preserved capital, that is when he stops thinking mainly about defense and starts thinking about offense. But you only get to act intelligently in stage 4 if you are disciplined in stage 2 and stage 3. Most investors never make that transition well because they are either overexposed when the break comes or emotionally shattered by the time the bargains arrive. They spend the crash wanting it to stop and the recovery wanting permission. By the time permission arrives, the easy money is already gone. I have tried throughout my career to build portfolios that do not require me to be brave after I have already been hurt. That matters more than people think. The investor who needs to improvise in the middle of panic is already late. The investor who knows his buckets before the panic begins has a chance. If I were explaining my own playbook to a younger version of myself, I would do it with 5 buckets. Not because 5 is sacred, because every serious portfolio in a dangerous period must answer 5 different questions. The first question is simple. How much dry powder do I need? That is the cash and short treasury bucket. Not because cash is exciting, because cash is optionality. Cash is the right to refuse bad prices. Cash is the ability to buy when quality becomes available below value. Cash is the one asset that does not need a narrative when the room loses confidence. People mock cash during late bull markets because they measure everything against momentum. I measure cash against distress. In distress, cash is not dead money. It is stored power. The second question is this. What falls hardest if liquidity keeps leaving? That is the short bucket. I am not talking about reckless gambling. I am talking about intelligent pressure points, businesses that only worked in a world of free money, weak balance sheets, commercial real estate structures that were never repriced honestly after remote work, changed the economics, regional banks, carrying exposures that become more dangerous. The longer refinancing remains expensive. The point of the short book is not to impress people with cynicism. It is to profit from fragility, that the market is still pricing as temporary inconvenience. The third question is this. What cannot be printed and may regain favor when trust in paper rescue declines? That is the gold and precious metals bucket. I do not own gold because I need a religion. I own gold because I have spent enough time around governments and central banks to know that when systems are stressed, the temptation to dilute paper claims returns like a fever. Gold is not a productivity asset. It does not compound the way a great business compounds. But in a world where confidence in policy and currency can weaken together, gold plays a role no spreadsheet can fully replace, and the miners, for all their flaws, can offer torque when the underlying metal moves. The fourth question is this. What wins if inflation proves more stubborn than the crowd expects? That is energy and hard input exposure. You cannot create oil with a speech. You cannot manufacture a barrel through a committee. Real things still matter. If the rescue comes through renewed ease, if the dollar weakens, if inflation breathes again, hard assets and the businesses tied to them may become one of the few honest hedges available. The fifth question is this: what can survive regardless of mood, that is, the defensive staple and essential cash flow bucket? The world can postpone luxuries. It struggles to postpone basics. That is why I always want part of my capital in businesses selling what ordinary people must keep buying. If the market tumbles and the macro debate grows loud, you still brush your teeth. You still clean the house. You still buy the medicine. The glamour sectors steal attention in easy times. The essential sectors preserve dignity in hard times. That is how I think about a portfolio in a liquidity trap. Not as a declaration of fear. As an architecture of optionality. Some people will hear a framework like that and complain that it is too cautious. They will tell you cash misses upside. They will tell you shorts are dangerous. They will tell you gold is old-fashioned and staples are boring. They will tell you that if the market keeps levitating, you will look foolish. That has never frightened me very much. Looking foolish for a while is cheaper than being wiped out. I learned that from watching bubbles longer than most people remember them. The crowd hates missing upside more than it hates losing capital until it actually loses capital. Then it suddenly discovers the value of boring things. By then, of course, the pricing has changed. That is why discipline must come first. I think there are 3 signals worth watching if you want to know when a liquidity problem is becoming a systemic one. The first is the long rate. When the 10-year Treasury yield rises and stays high enough to force a genuine rethink about debt service and valuation, that is not a normal market nuisance. That is the bond market telling you the state itself is not being granted the old assumptions for free. Long rates matter because they govern mortgages, valuation models, refinancing, and the cost of time itself. The second is the regional banking complex. When regional lenders start falling in a way that suggests hidden paper losses may need to become lived losses, I pay attention. Big crises often begin where the public assumes the institutions are too dull to matter. Regional banks are never exciting until they are the transmission line. The third is the credit spread. Equity people watch prices, credit people watch survival. When high yield spreads blow out relative to safer debt, credit is telling you something about fear, financing, and future defaults before the stock market has fully translated the message. Credit usually gets there first because credit has less room for theater, but the biggest mistake you can make is to turn these signals into ego. I have known brilliant men who ruined themselves not because they lacked intelligence, but because they needed to be right more than they needed to stay solvent. They married a thesis, they treated caution as identity, or they treated bullishness as identity. Either way, once the market contradicted them, they clung harder because changing their mind felt like personal humiliation, that is, childish. The market does not care about your self-image. When the facts change, you change. When the signals improve, you cover shorts. When policy actually reflates and you believe the odds have changed, you buy. When the market tells you that you were early, you admit you were early and preserve your strength for the better entry. I had to learn that the hard way more than once. Being right too soon can feel exactly like being wrong if you are leveraged to your own pride. So I do not try to be a prophet. I try to be a steward of odds. Right now the odds tell me something uncomfortable and very clear. Liquidity is being drained. Debt service is becoming heavier. The old assumption that policy can rescue everything without consequence is weaker than it was. Index concentration is hiding fragility rather than eliminating it. And millions of investors still believe that because the screen has not yet gone red enough, there is no trap. That is how traps work. They rely on delayed recognition. If you are a young investor, you still have time to recover from serious mistakes. That does not mean you should make them. But time can rescue you if you are disciplined enough to keep buying through pain. If you are older, or if your portfolio must support a family, or if your capital is supposed to buy you freedom rather than just excitement, then the sequence matters more. A major drawdown late in the game is not a lesson. It is a theft of options. That is why I always come back to optionality. The whole point of money, if you strip away the vanity around it, is choice about time, choice about work, choice about where you live, how you care for the people you love. Whether you can endure a bad year without selling your future to survive the present. A portfolio that performs beautifully in easy conditions but leaves you trapped in hard conditions is not a wise portfolio. It is a flattering one. I do not want flattering portfolios. I want durable ones. I want the kind of structure that lets me sleep when the crowd is bargaining with the screen. I want capital that can act when other capital is frozen. I want the freedom to buy quality when quality is unloved. That freedom is not built in the crash. It is built before the crash. I do not know the exact date when the surface will admit what the structure is already saying. Nobody honest knows that. The market may grind higher for a while. It may hand out one more round of comfort. It may make cautious people look old and stupid and timid. Markets do that. They seduce before they punish. They reward the wrong lesson just before they expose it. But I know this much. The window for easy complacency is narrower than people think. The reservoir is lower than it looks. The system is more dependent on confidence than the public realizes. And the investors who prepare before the recognition event are always in a different world from the investors who wait for the headline. You do not need to predict the panic to prepare for the panic. You need only enough humility to admit that a high index can coexist with a weakening structure. That is the whole game. I have spent my life trying to remember it when the crowd forgot, and I would urge you to do the same now. Do not ask only what can go up from here. Ask what must refinance from here. Do not ask only whether the index still looks fine. Ask what is happening underneath it. Do not ask only whether the Fed might rescue risk again. Ask what that rescue now costs. And above all, do not confuse the absence of visible panic with the presence of real safety. Those are two very different things. The liquidity trap is not coming. It is already here. Your job is not to panic because of that. Your job is to choose which side of it you intend to live on.